It's a picture-perfect day for the markets. While the exit polls are showing political continuity, the FY24 GDP number is showing an ultra-strong economy. Welcome to It's the Economy, where we are going to put the spotlight on what the GDP numbers tell us and whether we need to raise our expectations from the economy, given the political stability that is expected ahead. Joining me now are Sonal Varma, Chief Economist from Nomura, and Pranjul, Bhandari, the Chief Economist from HSBC India. Ladies, thank you very much indeed for your time. Well, Sonal, let me start with you. Your quick take on the GDP number, and more importantly, is it time to up the forecasts for FY25, current year?
Yeah, Latha, I think, another set of upside surprise led by private investments and a bigger contribution from net exports. Beneath the surface, though, we still continue to see this big divergence between GDP and GVA, and the reality probably somewhere in the middle. Now, in terms of should we be raising, the answer is yes. We have upped our FY25 GDP growth projection to 6.9% from 6.6%. And we think there could be some shift in the composition of what drives growth going forward, with some softening in urban consumption, but rural consumption picking up, and the fixed investment side largely maintaining its current momentum.
Okay. Well, a similar question to you, Pranjul, and I read through your report, so I have it. The worry about consumption only growing at 4% and the employment-heavy sectors like agriculture and even trade, hotels and transport not doing as well as the overall economy. Can consumption slow the capex cycle?
Yes, thank you, Latha. That's a great question. So there are a lot of good things happening in the economy. The credit cycle is strong. The construction cycle is strong. We have structural growth from services exports, which is strong. Now we have the RBI dividend, which would make fiscal consolidation a little less costly on growth. These are great. But at the same time, there are two important pillars of GDP growth that need more help. One is consumption and the other is investment. Now, if you look at investment closely, the top line looks great, but if you break it down, it has two parts. One is the real estate, the structures and dwellings, and the other is machinery and equipment. Right now, the entire rise in the investment cycle since the pandemic has been led by real estate and structures, which is government capex, India's real estate demand. The whole machinery and equipment hasn't picked up at all. In fact, on aggregate, it is lesser than pre-pandemic levels. And I think that's going to be a big challenge. And that, as you said, is actually interlinked with consumption. Only when consumption rises, my sense is that capacity utilization will, cross 80%. And then we can start seeing the machinery and equipment, the real private capex cycle really pick up. And that has not happened yet. And I do think that, that's one big challenge and big task cut out for, the government when it comes soon. And I think we'll get the first hint of it in the budget. My sense is that this RBI dividend, this, about 1.3 trillion rupees extra money that has been got, about half of it could go into fiscal consolidation. But my sense is the other half will go to welfare spending to basically push up consumption, which is, I think, the need of the hour.
Okay. Yes, that is the hope that the extra money will go into consumption, something which Somanathan incidentally put me down when I tried to suggest that post the budget. But Sonal, the fiscal deficit number, besides the RBI dividend tax collections, look at the April number itself. I think it's 17% higher tax collections. Do you think that this can advance the sovereign upgrade? And even if the rating agencies don't upgrade, the market itself will give an upgrade because of the fiscal deficit number. Instantly today, all the PSU stocks are rising, obviously because they have very good bond holdings. Your take on whether we should expect generally lower rates for the economy?
Yeah, Latha, I think just in terms of the fiscal deficit, the budget, whenever it's presented in end June or July, with this additional dividend, there is scope for the government to slightly advance the pace of fiscal consolidation while also keeping some buffer for exigencies that may arise, which we don't know about right now. I think the argument of using the entire extra for more capex is just hard to implement because we don't have that much time left, and it's hard to actually, crunch in 12 months of capex into 9 months. So we do think there is a chance that in the final budget, the pace of fiscal consolidation could actually come in faster, which from a bond demand supply perspective actually looks very favorable, because end June we'll also have the index inclusion process actually begin. I think the second issue, which is linked to your point of rating agencies, I think in general the macroeconomic backdrop for India is looking a lot more favorable. Political stability, policy continuity, focus on supply side reforms, macroeconomic stability, fiscal consolidation, which to our mind means that India does deserve a lower risk premium compared to what it was historical average. So even though there's a lot of focus on US yields based on US data and macro fluctuations, the domestic political stability and the domestic economic stability, more importantly, actually argues for a slight delinking of India yields versus global yields. Rating agencies typically tend to move more slowly. I think what one could look for now is for other rating agencies outside of S&P to probably also move India to a positive outlook. It could take a bit longer for an actual upgrade to come through, but I think the fundamentals are moving in that direction.
Okay, your take on the same thing, Pranjul. Cost of capital for Indian industry likely to fall? I mean, you've already placed your finger on dwellings and real estate. So, a greater consumption thrust because of home consumption. Anything positive that you see because of the cost of capital?
Yeah, sure. But I just want to also add something on the S&P. My sense is that they've actually lowered the bar for India to get an upgrade. They actually said that the center plus state fiscal deficit should be 7% or lower. And actually that is achievable in a 2 to 3 year horizon. And we've done it in the past, center at 4, state at 3, 4 plus 3, 7. It's happened easily in the past. It was 6% that we were never able to achieve. 6% center, 6% state. So, by just actually making 7%, the norm, and not talking about a debt to GDP ratio, I think the bar has been put lower. So I think that is a positive. The second part in this whole thing is, what would the RBI do, in the cost of funds?
Yeah.
And my sense is that, that later in the year, perhaps around October, we could see a rate cut by the RBI, especially if, the monsoons are fine and we see a sign of food inflation falling, which is right now the bigger worry in the inflation basket. And 1 year ahead inflation forecast is coming closer to 4%. My sense is we will see that 25 basis points rate cut followed by another one, an overall easing of 50 basis points. So this whole package of, fiscal consolidation going down as expected, and hopefully, getting down to 7% in the next 2-3 years, the RBI easing policies a little bit, I think all of that is going to be something that will positively impact the economy at large.
Okay. Well, that's on the fiscal, on the interest rate side. But what about the broader policy expectation, Sonal? And I'm not restricting myself only to this year and the impact on this year's economic growth. More broadly, with political continuity, Mr. Modi is already talking about 125 days of policy thrust. The top 3 things that you expect.
Top 3 things, Latha. There's actually a long list.
Okay.
I think
Go ahead.
Sure. So I think there are policy objectives that are in the domain of policy continuity, which is the continued thrust on capex, faster fiscal consolidation, focus on macro-financial stability, disinvestment and privatization potentially coming back, into the radar. Now, the second leg, I would actually put reforms that we have to take to really, for the economic takeoff in India to happen, which is possible. And there, I think the factor market reforms on land and labor, the reforms around judicial, law and order, bureaucratic reforms, on the tax front in terms of rationalization of GST, enhancing the tax net by bringing in items like petroleum, and a lot more actually, Latha. But I would say it's going to be a mix of continuity, but also taking the next step, which is very essential for productivity and India's competitiveness to take off. So more broadly, we, and I would say the investor community, is looking for the next step.
Okay. A similar question to you, Pranjul, and also what I didn't ask you, what will make you up your GDP forecast?
Yes, absolutely. I break down reforms into easy and hard. I'm simplifying a lot here because easy is not really easy, but easy as defined as the things the government is already doing and doing very well. The push to public capex, focus on futuristic investment sectors, a good focus on macro stability, bringing down fiscal deficit, bringing down inflation. All of these are great. And my sense is if that continues, we could see about 6.5% growth over the medium term. But the challenge is, how do you move from executive to legislative reforms? And that is where the hard reforms come. Things like land, labor, ease of doing business, a new direct tax code, hopefully even some judiciary and bureaucratic reforms. I think if we can actually get that done, or even a few of that done, then in the medium term, my sense is that India could be a 7.5% to 8% economy. And that is the real challenge. I think we've done the easy stuff, and even continuing with that is good. But the real positive, growth jump will come once we move to the harder, the legislative and the more controversial reforms. And my sense
like
is
your
we should
point
get a
about
hint of that, in the budget. In the budget.
Yeah. Now, very quickly, Sonal, this longer-term growth forecast, while we are all enjoying the fact that post-COVID our numbers are 9.7 and 7 plus, an average of 8, if you take a 5-year term, we have not filled the COVID gap. If you go from 2019, our growth is still sub 5%. So do you think a quantum leap in growth is likely?
Latha, I think it's possible. The upside surprise that we've seen so far has been despite all subsectors participating. Rural consumption is soft. Private consumption, private investment is not yet broad-based. So whatever growth we have seen and has surprised on the upside has been despite all of that. So I think the conditions are falling in place for these segments to actually do better. Ultimately, if confidence is back, if India is seeing supply chains move, which should create more jobs, construction, real estate, these are the more employment intensive sectors, which is in turn a driver of rural consumption. As those sectors start participating, I think the average growth can definitely be much higher compared to what we've seen, and more importantly, the composition of growth that we get going forward. So we do think on average, the next 5 years could be 7.5, and depending on what kind of tough reforms we implement, it could be even higher, but 7.5 is our baseline right now.
Oh, that's music to our ears. Thank you very much, Sonal and Pranjul, for joining us. These are only the initial conversations. We will have many more like this after the poll results come out and we know the composition of the cabinet and the first 125 days of policy that Mr. Modi has promised. We wrap up on Bazaar on that note. Thank you, Sonal and Pranjul. The markets, after losing, after seeing some profit taking, is now clambering back to a 3% gain and to the 23,200 mark. I think much more gains are in store for us. Wrap up on Bazaar. Chartbusters will take the action.